Okay, ladies and gentlemen. Okay, ladies and gentlemen, welcome to Macro Ace with your host Tony, going through the Eia inventories. As always, with the Eia inventories released, there's always a lot of sentiment and news to go through. So let's make a little start. So first of all, what is Eia inventories? So it represents a weekly change in crude, gasoline, and distillate inventories, and the main areas that it affects is transportation. Also affects consumer prices too for a number of products. So, of course, a lot of products are made using oil. If you're thinking of your plastic goods and that are made and a petroleum jelly, a lot of things are made from it. But again, transportation, and it has an effect on consumer prices as well. Why is it a release to watch? Well, you can when sentiment isn't driving the market so much and things are start to calm down. It can be a very volatile trade where you can see some moves of sometimes you can see a move of about $2. Recently, we've seen moves of about $1.30 or under $1, around 50 cents. But it can be a very volatile trade. So that's one reason why it's a release to watch. Also, how does it affect the markets? So this is the basic understanding that everyone needs to have when trading Eia inventories, is that when more oil is added or when there's a build in inventories, that's negative for oil if there's less demand for it. And when there's less oil added or when there's a draw in inventories, it's positive. And you see prices rising for crude in the markets, and also potentially for natural gas as well. But one thing to again just to make quite clear is that when you are trading the inventories, is that again supply and demand is quite key. When there is more oil added, you've got to understand that there may be less demand, so the price of oil could be cheaper, and vice versa. When there's less oil available and there's a high demand, then it becomes more expensive. Or when there's geopolitical uncertainty that is heightened, that can lead to higher oil prices. So carrying on then, we have the triggers that we need to go through. So this is according to economists of what they see as their triggers today. So crude with a high estimate of 2.5 million and with a low of minus 12 million. Gasoline with a high of 1.3 million with a low of minus 5.6 million. And distillate with a high of 1.6 million with a low of minus 1.5 million. So if we're looking at the forecast as well, just for all the median estimate that economists have, so we can see that crude oil inventories is expected to come in as a build at minus 2.129 million. Gasoline is also expected to come in as at a build as well at minus 1.641 million. And then distillate to see a slight draw to 1 million, or a draw on the inventories there. So overall, I think that's why economists they're expecting that if there is a build, you're looking for a smaller figure to kind of confirm that, and for a draw, which will be a big surprise. And hence, they're looking for a bigger deviation on the forecast figure. But if we're looking, that's what we'll look through a little bit later on about the deviations too, and just so we kind of gauge for ourselves what to kind of expect, what to look out for. So the API data, a bit of data that is kept an eye on by traders and economists, private data that is released the day before the official government data is released, can show which direction, or has had in the past, a correlation with which direction the official data could be. So if API data shows that crude was the build, then the EI data, sometimes there's been a correlation where there has been a correlation where official data has also shown a build. That hasn't always happened. A lot of the time, the correlation hasn't been that strong. Where there might be the actual figure might be headed in the opposite direction, but it's something that traders do keep an eye on as like their own forecast in a way, or foreshadowing what the data could be the following day. So API's crude oil stock change data came in as a build at 0.567 million compared to the forecast of minus 0.69 million. So came in as it did come in as a build, but it was a much stronger build than expected. Gasoline stock change actual was minus 4.233 million compared to the prior minus 5.1 million. Again, a build there. And then for the distillate stock change, similar to what we're expecting today, it did show a draw there, they did show that it came in at minus 0.949 million compared to the prior of 1.7 million or 1 million. So I think again, so the data yesterday, usually what happens is that we can get some volatility the day beforehand with the API data. We did see the prior week, we did see some strengthening off of the API data showing a draw. But yesterday, there wasn't too much of a reaction to the API data, actually. We did see very minimal movement, where we did see some slight movement towards the downside off of the build that had come through, but it didn't really do too much. So again, what does that mean for today's release? Could we get a lot more movement? It has happened sometimes where you can see API data show not a lot of movement, but the EI data itself can show a lot more volatility or movement itself. But again, that all depends on the sentiment that's driving the markets at the moment. So going through that, then what's driving sentiment at the moment? So on Monday, we had the oil eased off of earlier gains, with European Union's proposed ban on Russian oil looking increasingly unlikely to pass when the bloc's leaders meet next week. So you've had Hungary that's been the sticking point, saying that they might not agree to an oil embargo or a Russian energy embargo with the rest of the EU. Remember, with the EU, it has to be a unanimous decision for them to be able to say, okay, we are going to ban Russian energy altogether. But Hungary being a sticking point there is causing some issues for the European Union. So WTI fluctuated near $110 a barrel after earlier rising as much as 1.5%. So that again, on Monday, the EU's proposed to phase out Russian oil as it had reached an impasse, with Hungary continuing to oppose the embargo. And then the government signaling that any progress on talks will likely slip next month at the earliest. So remember, if there is a stronger chance of an oil embargo happening, and Hungary is more inclined to actually go for an embargo, remember, the less oil or energy that there is within the market, the higher the prices will go for crude oil, gasoline, distillate, with that loss of Russian energy or the instability that could potentially come from an oil embargo altogether. So again, that's one thing to consider. That's kind of been pushing the oil markets, or had pushed oil markets down a little bit with those talks. But there's other bigger drivers of sentiment that have come through. So we know that from the IEA, they also said on Monday that they see prices going even higher, being much more volatile, becoming a major risk for recession for the global economy. That was according to Birrell, who's speaking on Bloomberg TV from Davos. So one thing to note is during recessions, oil prices, what can happen is that if there is a recession and there is less being produced or drop off in productivity, that a lot of the reason why that happens is that crude oil prices rise to quite a high amount because if there's a high demand for it before the recession, then that drives up the price of oil. But then during a recession, when things are looking gloomy and there isn't really much of a demand for oil, that can drive down the price of oil instead. One thing to consider as well with the dollar, that's also a very key factor as well, how strong the dollar is. If the dollar is stronger, if it's seen as a risk-off asset or safe haven asset, it could keep oil prices down and make it easier to buy crude oil. But if the US is facing issues and there's nothing to kind of back up the dollar or to keep it afloat, then that can make it more difficult to buy oil if it becomes more expensive. Remember, it is measured. Oil is measured, or buying oil is measured in dollars, right? So that's what the Saudis had agreed with the US and also the rest of the world, that oil is going to be traded in dollars. So that's one other thing to consider too. China lockdowns. So we've had 2 months or more than 2 months of lockdowns with China in Shanghai, parts of in areas in Beijing. That we've had issues where China lockdown has hampered demand for crude oil, where we've seen a depreciation in oil prices, not only for oil prices, but also for stocks as well. We've got to consider that the last time, of course, during the first wave of COVID, when there was uncertainty and when China itself was went into lockdown, it had removed the positive or bullish sentiment and had driven to markets to go into a risk-off mode. So you'd seen S&P 500 and the US stock indexes tumble off of the China news and WTI crude oil, because there was less demand coming from China and also then to the rest of the world. That had also kept oil prices down as well. But this is one interesting thing. Even though we've had quite a long lockdown in China, you had some news according to Vortexa, so that 20 of 21 oil cargoes at Port Cozumino have been loaded to be sent to China, which is the biggest monthly intake since 2016. Then OIES senior researcher Maiden has said that they see Chinese oil imports recovering later this year, with refiners limiting runs until demand heals. And then China itself, what they had said last night, news that was quite important for how well the recovery or how well the COVID lockdowns are going in China. You heard from Li Kang, the Premier of China, or the Vice Premier of China, the Premier of China, saying that China seeing growing at 4.5% this year, but that is lower than the government projections. So what he did mention is that COVID is having an impact on in industrial activity and productivity as a whole. And when that happens, we were more or less looking at a similar situation in the first COVID pandemic, where demand for oil had slipped off if no one is using it to make any products from it, or use it to fuel transportation and so on and so on. So that's one of the things I think we've just got to understand, is that last time we had China-driven news, that where we had seen a little blip move towards the upside or appreciation in WTI crude oil, when we had seen a very big draw in inventories. But then the overall sentiment was that China staying in lockdown and that potential further loss of demand for crude oil had pushed the markets to continue to move towards the downside. So that's one thing I think we've just got to be aware of for today with the release, that we could see, even though if we do get a big deviation, we could see a little blip in a reaction, and then the market's kind of carrying on in the way that they're moving off of the potential other bits of news and sentiment that's driving the markets. Also, if we're looking at yesterday too, so oil had dipped after the US announced the SPR sale of 40 million barrels, and WTI settled below about $110 a barrel. So the US is also having an impact too on sentiment as well, right? So you've got China as one of the big drivers, and also the US in a short-term way supplying more oil to the markets had seen WTI crude oil settle below $110 a barrel. So this is one thing I wanted to kind of show you too, just an illustration, just a little line graph that I made in regards to retail sales and industrial output. Again, industrial output is the key factor for China when it comes to their GDP and their growth, and also their retail sales too is also one of the other important figures. So we can see here, just a reiteration, that at the beginning of the COVID pandemic, we'd seen a huge drop off in industrial output, around about 15% or 15% drop off there. And then we start to see that recovery in the industrial output retail sales. So we bottomed at minus 20% retail sales for better data, and around there, I said around around 16% there. We'd bottomed for Chinese industrial orders, industrial output year on year, or industrial orders. And then we peaked at around for industrial output year on year, near enough, near towards about 40%. Similarly for retail sales in that 30 or on the top end of the 30% region. And then as we're starting to see, of course, from that big jump or that jump from going from no production or to minimal production to starting up the factories again, and consumers buying more products and being able to, we've seen that slowdown in growth. And then here is where we have the second sort of lockdowns, the second big lockdown, let's say, since the last COVID pandemic, since the last first COVID wave. And then we see that drop off again. So could that mean that, of course, with demand for oil, could that drop even further? And could we see oil pushing lower than $100 a barrel if China continues its COVID restrictions and drop in demand? There is one probability we've got to consider, is that could, as said, could be continuing to push the markets, even if we do get some good data from Eia Inventories. Other bits of news to be aware of as well. So you had the Biden administration considering tapping, this is yesterday as well, a little used emergency diesel fuel reserve from New England to mitigate a supply crunch amid Russia's invasion of Ukraine. And the White House is weighing an emergency declaration that would allow it to use a Northeast home heating oil reserve located in New England. Contains about 1 million barrels of ultra-low sulfur distillates, according to the White House. So that could be used, as said, for heating homes. So the US jumping in, dampening the price or dampening some of the pressure, the upward pressure that we've seen in the oil market so far, and also the commodity market so far, with natural gas and distillates. That could help drive that down further. And then again, something that if you're in the US, you would of course know, and globally as well, we've seen that the motor fuel prices have surged. So this is just a good line chart to show you that how much of an effect the Ukraine conflict has had on not only for exporting and importing crude, but also for consumers as well. So you can see and also for businesses. So motor fuel prices, as you can see here, so not reaching an all-time or a new fresh record. We can see the fresh record was reached with the gasoline price at around $4.59 a gallon. But again, pressure is still there that the Ukraine conflict is still lingering, where there is uncertainty that isn't as strong as to keep oil going up or an upward momentum. But just from an economic standpoint of view, that's one thing just to be aware of, that that's where we are in the US with the US economy in regards to motor fuel prices and inflation that is having an effect on the US. So again, just a nice reiteration there, just a source from AAA, just being picked up from Bloomberg there. Then Aramco and the Saudis. So you had Aramco that said that in regards to the aviation industry, it's got to be one thing to be aware of, that it could be a major problem for global oil supply, and the world is running with less than 2% of spare capacity. So Saudis and globally the other oil producers have been producing, in regards to Aramco, have been producing near enough at capacity. So what the Saudis have said is there's nothing more for the kingdom to do, right? And in that case, if there's no more pumping of oil, that could happen for the markets when there is a demand, and when there is more of a demand for oil, that is one thing to consider that could push up prices further. But this is something that's been repeated, some rhetoric that the kingdom, that Saudis have said before, that the Ukraine conflict is more of a political issue rather than about supply itself, driving countries to ask for more oil. Hence, we're seeing capacity shortening. But Saudis are not really looking to jump into the markets to try and save everyone, as the US has tried to push them to do, is to pump more oil, to try and dampen down energy prices and also bring down the cost of WTI and also Brent for India too. That's also another thing. India wants cheaper oil from the Russians. If there is no demand for Russian oil, or if there's less demand from Russian oil for Russian oil, then the Indians would have recently said that that we've had actually a headline not too long ago today that you have the Indian government to continue to buy cheap oil from Russia, as according to a source, India's oil basket is over $100 a barrel. There have been talks in the past where India could get a discount of around $30 a barrel, but again, that's not been clarified as to whether that is going to happen. But of course, cheaper oil, if you provide someone with cheaper oil, you've got to see some downward pressure in the oil markets from cheap oil being provided. If the Russians were to raise the price of oil instead, or to keep prices where they were for India, that could mean that there is further upward pressure in the oil markets. But the Indians wanting that cheap oil could bring oil prices down further if that does kind of go ahead. There are discussions of whether or not the payments will be done through rupees instead of rubles, which is what the Russians want everyone else to do, to pay for Russian energy in rubles rather than the dollar or the euro or other currencies that are used to buy oil. But that's just one thing to consider there. So investment bank, so you've had Mizu saying that we're stuck in a range of $105, $116 a barrel, and they're looking for a breakout, and saying that the European embargo on Russian oil will likely send crude prices to touching all-time highs. Again, the potential for an embargo happening, according to investment bank's view, Mizu, saying that if the embargo does go ahead, that will add further upward pressure in the oil markets. But if it doesn't, and it more or less stagnates, then there's not much there's not much really potential movement towards the upside. We more see some more choppy movement towards the downside. So something to consider. So this is the last release that we had. So if I just mute myself there. Okay, so about 10 seconds before the release, and we'll go through the deviations too. I don't want to miss that out. So we're seeing, it was an overall draw on the figure, seen a little bit of a pop up towards the upside on there, where we'd seen about 43 ticks towards the upside on WTI crude oil off the back of that data. It wasn't, even though we had a deviation of about, we'd seen that even though we had a deviation of about 5 million or 5.3 million from the forecast, the actual figure compared to the forecast figure, the reaction wasn't that strong. So in the past, when we've seen about 5 million deviation, there's been a slightly stronger movement. But I think when sentiment is taking hold, and if I kind of go forward a little bit more, we can see that move actually reversed when data was overall showing a draw in inventories. So that was due to sentiment of China lockdowns having an effect. That was due to the China lockdowns having an effect on sentiment overall. But that's why we've seen that quick flash move towards the upside off of the bigger than expected draw. And then we'd seen the market sentiment continue to push the markets. Okay. So then if we look at the crude oil market so far for now, let's move that here. Okay. So yeah, so as I was saying, today's sentiment, so crude oil up about 0.4%. A lot of this downward movement that we can see so far is partly because of China and the continued lockdowns. And then also we've got to consider as well for WTI crude oil is that you also have the Indians looking for cheap oil too, and that there is still discussions are still ongoing with the Russians. That's what's kind of keeping, although the market is slightly up, I think that's one of the main drivers of sentiment. So if we look at the deviations, then we've got about 5 minutes. So this is what we had seen last time. As said, there's about 43 ticks towards the upside, and then about 10 minutes later, we were about 80 ticks down on WTI crude oil. So again, sentiment, seeing a quick flash reaction, and then it wiped out that gain of about 43 ticks and continued its movement towards the downside, even though, as I said, there was an overall stronger draw in inventories. So if we're comparing today's median forecast, this is of course not the actual data for what economists are looking for. So economists are looking for about 4.6 million deviation in the headline figure, and overall looking for, bearing in mind this is the highest estimates that we're looking at from the economist point of view. This is what they're looking for if we're seeing a build. They're expecting about 4.6 million deviation. As I said, headline figure on the flip side for draw, they're looking for about 12. The figure to come out at minus 12 million or lower. I think one thing we've got to consider though is that when a sentiment is driving the markets and releases don't react so much or don't hold their initial appreciation or depreciation, and they kind of just carry on after the release has occurred. In the past, what we've seen April 13th is what we've got to consider, and also April 20th. So when there was about 8.3 million deviation, or about 8 million deviation with the headline figure compared to the forecast figure, and it was bigger than the other two figures, right? That's also another thing you've got to consider. Then we had seen a stronger movement in WTI crude oil, where we'd seen about 132 ticks towards the downside, or about $1.30 towards the downside. Okay, so again, I think if we're looking at today, I think the 5 million that we're expecting last week didn't. We did see that reaction, but with sentiment that had driven the market, I think you'd be looking at something much, much higher, probably in the range of about 8 million of a deviation from the forecast figure or higher. Either way, I think for a build or a draw, I think that makes more sense. As said, we want to be kind of careful that. I know I had a question from somebody in an email saying even though the markets and the news was pointing for everything to go up, there was a China sentiment and news that had made the market ignore the release after the first candle kind of moved towards the upside. So I think that's what we've got to consider. We need a bigger deviation when sentiment drives the markets. Hence, we're probably looking for at least 8 million of deviation within the headline figure itself. And then we'll look for the other two bits of data to kind of support that for a stronger reaction, whether it's a draw or a build. If we do get the other two bits of data that are more or less a bigger draw or build compared to the headline figure, then I think we'll see a bit more of a choppy reaction where the momentum or the direction of the movement isn't going to be clear. So we've got about a minute left. So if I bring up tick strike 2 for you. Where are we? Oh, I moved them all to another screen. Right, there we go. Crude, there we are. All right. Let's quickly look through the chats. It said, once over inspections, said, great show again today. Much appreciated. No worries. Hopefully it is useful for you. And it has helped you with your trading. I hope it has. And anyone else who is watching, if this is the first time today, I hope it kind of helps you with what to kind of expect from the markets. Right, I've got about 15 seconds. So again, economists are looking for a build overall in inventories with a slight drawdown on distillate inventories. Okay, so that's a build minus 1.019 million compared to the forecast of minus 2.129 million. WTI crude oil seeing some movement towards the downside there off of that data. Overall, data is showing a build. So, okay, let's see how long this reaction lasts, because I know last time when sentiment was driving the markets, it was about a minute that we had the reaction to the upside, and then it continued its movement. Okay. So as said, gasoline inventories also build at minus 0.482 million. Distillate also build at at 1.657 million as well. So overall, okay, there we go. See what I mean? So the reaction happened, right? We've seen the move towards the downside, and then that's it. The trade was wiped out. Nada. Nothing, muchacho. It means nothing. Let's get the deviations too on that there. All right, okay. So the deviations then, so we've got about we had seen about 1 million deviation on the headline figure, and then gasoline similarly again a 1.1 million deviation, and then distillate about 0.6 million deviation. So didn't really meet our, as I said, what we were looking for today with sentiment driving the markets for about an 8 million deviation on the headline figure, which is quite large. But I think rightly so with how the markets, however, or how the how WTI's reacted to the release. Again, I think sentiment has taken over, so it hasn't sustained on that from that initial first candle. It didn't sustain its move towards the downside from what we've seen, although it is still lower at the moment pre-release. Before the release, it's more choppy compared to the other nicer reactions that we've had, where we have seen a nice big old deviation. We've actually seen like if we go back to April 20th, when there was 127 ticks up, it was still up 10 minutes later by about 118 ticks, and then took about 52 movements for the movement to for WTI to settle back to where it was pre-release. Obviously, that's not gonna. That looks like it may not happen today, but yeah, there we go. All right, it's done. Alrighty. Anyone have any thoughts or questions in the chat? If you do let me know. One thing to consider though, if you trade, if you're trading the markets, one thing to understand and to be aware of is that news such as the Hungary news, we're looking to maybe be an impasse for the European Union when it comes to potentially having an embargo on Russian energy, and also how China lockdowns are having an effect on the crude oil markets. That bit of news is that you can find here on the Financial Juice news. Actually, let me not cover the market. I'll kind of, there we go, that's a bit better. That bit of news you can find on the Financial Juice news feed. So if you're unsure, it's like, wait a minute, why is the crude oil market down, or why is it moving? Why is it moving up by a lot? And this is the place to be, right? News mainly drives the markets. Of course, you have your technicals too to be aware of, but fundamental news, right, or global geopolitical news is what moves the markets. And that's what we've seen recently with the Ukraine-Russia conflict, with the central bank tightening of monetary policy globally, and also the lockdowns in China that have pushed news, or that have pushed the markets in the direction, and we've seen that increase in volatility in the markets because of news. Also, a news service or live voice and text service is what investment banks use, right? So they're always, of course, keeping an eye on and an ear to what's going on. So they will have this, right? They won't maybe not have like a website like we have, which is much nicer and easier to kind of follow the news, and also to keep everything in one place with the economic release on the left hand side. But they use that to manage their risk, right? News, the way what I've seen a lot of traders do when looking at news or using a Squawk service is to manage their risk that's going on within the markets, right? And sometimes they can use it as a trading opportunity too. So that's why with the news that we have, it's real time to the second, right, of when we get the news, and it also means that so there are two versions. Okay, so with the pro version that you're currently looking at the moment now, which has no ads, no delay to the voice or text, right? You can also, as I said, get real-time economic releases coming through, as I said, to the second. And for those economic releases, what you can do is you can also set your triggers as well, right? What do I mean by economic release triggers? So if we were looking at the triggers that we're looking for the release today for Is Eia Inventories, let's say if I wanted to buy or sell crude oil inventories, maybe I could set my buy if we had seen a really big draw at, let's say, minus 3 million, and then a sell if we see a big build, let's say 5 million or something to that degree. Then that will set itself here with a little, that'll set itself here. And when the figure matches the figure that you've put in for your trigger, okay, then it will show with the little buy or sell signal, sell sign here. Again, it's a manual thing that you put in yourself, nothing that we do. So even if you do see here, it's just showing you the forecast of what it currently is. It's not showing you what to put the figure in as yourself. But that is also real time too. So the live version, everything is delayed. You get ads, right? Which nobody wants to see or hear. It distracts you from your trading. So having a pro or a real-time version of the news service is very key to have. Now, what we want to do for you guys, so we're being fair to you and giving you an opportunity to experience the news service, is 7-day free trial. Okay, that link I've just put in the chat for you to have a look at, and to be able to test whether or not it's something that you would consider using for yourself. But I think, as said, it's a key thing. Investment banks use it. It's a good way to manage your risk in the markets and understand, know what is happening in the markets, right? And what is happening globally that is having an impact on the markets, right? Then, as you can see, I've been using tick strike here. So let me minimize this little window. We can kind of see the movements in WTI crude oil at the same time. So one thing to bear in mind is that sometimes for traders, they could see big, huge moves happening in the markets, right? You have the news that's come out. Okay, let's say with WTI, maybe China's decided that they're going to cut off Russian energy, which would be a bit of breaking news because they rely on Russian energy. But let's say that the markets take that in a very negative way, okay, in this scenario. So tick strike, what it does, it allows you to listen to order flow, right? How much momentum is there in a certain asset class or different pairs of stock indexes or currency pairs, right? That's what tick strike does. So imagine you're in the trading pit, okay? And you've got all the guys and gals standing there. They're waiting for the market to open up, and the market's open, and they all start shouting, buy, 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 sell, 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 1 point, buy it, buy 50 shares of this, blah, 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 right? That sound is translated or put in or translated into tick strike, where you get audio. The audio is turned off at the moment, but you get an audio ticker, and you also get a visual aid too, to show you how much momentum that there is in the market. So as you can see here, crude showing some seeing some downside momentum. So tick strike at the moment showing that there, evidently at the moment. So still selling momentum is still quite strong there at the moment in WTI. One thing that you can do is so again, tick strike is there to kind of help you to understand how much momentum that there is. Okay, and again, it can be used for a lot of people. They can scalp the trades. A lot of people use it to scalp trades or scalp the markets to trade, and also for economic releases too. Let's say with the EI inventories, if there is upward momentum or downward momentum from a really strong figure, how long would that last? And you can kind of tick strike it in that way to kind of gauge to a degree in your own analysis, right? Whether or not that momentum is strong enough for you to kind of continue. So going back to your own gauge, so with tick strike, you can go from, so you have 1, which is the most sensitive level, i.e. any small bits of movements that meets the criteria for tick strike to go off, then that will kind of show up on the ticker here. So again, see a little bit of buying movements, buying momentum here. You can see the tick strike is going off there, but it chops and changes quite a bit. So if you want to see, bigger moves of a bigger move in momentum, then what you'd want to do is you'd want to raise that level of sensitivity as much as you want to 15. So when there is a big move or there's a lot of volatility going on in the markets, only then will tick strike, if it does meet the criteria, only then will it go off with a audio or visual aid showing you as here. So at the moment it's on 15. Even though we are seeing a little bit of selling going on here, tick strike hasn't gone off. So again, that's something that you guys can try out. And the way you can try that out is also with I know, okay, it's a little bit cheesy. Another 7-day free trial of tick strike that you can have a look at too, and see whether that works for you. So just remember, if you're looking at the website and thinking, well, I'm on the live version and I can see tick strike there, just remember that's set to one setting, which is 6. Okay, it doesn't allow you to change the level of sensitivity, and there aren't a lot of. All it shows is the main or the biggest traded or the mostly traded assets. So the S&P, the euro dollar, oil, and Bitcoin. Those are just some of the assets that you have. But Tick Strike Pro, or the full version of Tick Strike, you can trade currencies, futures, ETFs, ETNs, and stocks as well. There is a plethora of different assets that you can trade or you can look at with Tick Strike. So instead of being limited to maybe 3 different tickers with a set level of sensitivity, Tick Strike, or the full version, allows you to go deeper, right, and see the momentum of the market overall. So if you're looking here as well, I have maybe the S&P, and I've got the NQ. Again, maybe the S&P could be moving in one direction, it could be moving up, but maybe the Nasdaq might not be following suit. Of course, it is at the moment, but it's another way for people to kind of gauge what a certain asset class is doing. Are commodities, rising altogether, or are indexes showing a strong correlation where they're all moving towards the upside? And what does that mean for your stock or for your trading of a stock index? So that's Tick Strike. Okay, so you've got two 7-day free trials, one for financial use and one for Tick Strike that I've put in the chat for you there. Of course, show us love on YouTube. If you've liked this video, then like it, share the video, and subscribe to our channel. It would be really appreciated to show your support and show that what we're doing works and is useful to you guys. And also follow us on Twitter too. So give us a follow there. One thing I did want to mention as well is that the deviations that I was showing here on the the deviations that I was showing here, this is something that people on our main list will receive, so they get a bit more time to kind of look at the data and how the data has reacted to, or how the market has reacted to the data, and what kind of a deviation are we, are we looking for to get whatever sort to get strong movement in the markets. So that's something that I said our subscribers to our mailing list get to receive, but also on top of that, for subscribers, we give them on a Sunday the week ahead of what to expect for releases, maybe newswise and newswise as well. What are the big topics that are going to be potentially covered or come out through the week? That's what's provided in the subscribed version of Macro Ace. So if you join the mailing list here, you can stay up to date with that. Bearing in mind, if you do subscribe to it, sometimes there are going to be weeks where it's very quiet, not a lot happens release-wise, so then there may not be a lot of news to kind of cover, or not a lot to cover release-wise. But when it does get nice, big, nice and busy and juicy, when we do get, let's say, the FMC meeting with their rate statement, or the rate decision, or any other central banks, which we do have coming up in June 15th and 16th, where they go to the Bank of England and the Fed in 1 week. And before that, we get the ECB on the 9th of June. So when things start to pick up, then there's more news. But sometimes there'll be weeks where it's kind of quiet. But just something to expect. All right. Thank you very much for joining me for the EIA Inventories release. Hope you found it useful. Do let me know if you do have any questions. Put it in the chat or the comment section, and I'll try and add anything or change anything. If you don't like it, or you want to improve something or add to the service to make it even better. Right. Thank you very much. Take care.